This past week, the market ran up by almost 6%. So does that mean that we're in the clear and a recession is off the books? Or was this a bear market rally? So that's what we're going to cover in this video. So guys, smash that like button. And if you're new to the channel, please consider subscribing. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So of course, you guys saw that the market snapped its 7 or 8 week losing streak this past week and was up 6%. So the question I ask, and you guys can let me know what you think in the comment. There's no right or wrong answer, but what I think is that this could potentially be a bear market rally and we have further declines ahead of us. And so this is what I mean by that. So you can see here, this is a chart of the S&P over the last 5 trading days. You can see this is where I got the fact that it was up almost 6%. And then going into the next chart, you can see that year to date, we're still down over 15%. So year to date, it's not like we're not in a bear market type environment. Now, of course, bear markets are described as 20% or more of a decline. However, we're knocking on the door there. But of course, the question is the market going to continue to run over the next week, or was this rally sort of a temporary thing and we're going to move more into a decline? So of course you can see that since pre-pandemic levels, the stock market is still up considerably from nearing that 3,500 mark to over that 4,000 mark. So there's still quite a bit to go down if the market is in fact overvalued. Now there's 2 measures that I use to determine if the market's overvalued. The first one here is called the Buffett indicator. And what this is the ratio of the market value, so the market cap of all the stocks, to the GDP. Now, there are problems with this measure, one being that companies could obtain earnings globally, yet the GDP, the denominator, is only based on US GDP. So there are issues there where this measure could make the market look more overvalued than it currently is. However, this is just one indicator, and so just looking at it, it suggests that the market is 1 standard deviation higher than its 70-year trend line of what's fairly valued. And if you look at it from a shorter term perspective, so this is more of a 30-year timeline, you could easily argue that a little bit higher than that 0% figure is where the average should be. But even from that perspective, you would conclude that the market is at least a little bit overvalued, if not a full standard deviation. But as it stands, the Buffett indicator suggests that the market as a whole is 29% higher than the long-term trend line. So another indicator that we like to use is called the Shiller PE ratio. The Shiller PE ratio effectively measures the price of the market divided by the average earnings over the last 10 years. So of course, there's a historical bias which will make the chart look higher than what it should. However, if you go all the way back to the 1800s by that, it sort of evens itself out. So the Shiller PE ratio is not a bad indicator. It's not perfect, but you're seeing here that it suggests that the market is more than double what it should be valued at. And the Shiller PE ratio average multiple is around 15 times earnings. Now, you guys will notice that when I value companies in each of those models that you can click in, I always put a terminal multiple of something in between 10 times and 20 times earnings. And the average is around 15. I never have a high terminal multiple. And so if you're going to put a really high terminal multiple, it suggests that the earnings in the future are going to grow at a rate that is greater than what they have in the past. And I just don't know if we're there from the perspective of the overall economy today. And so I would say that I would agree with the Shiller PE ratio based on my own research that the market is overvalued. Now, I will show you the tracker to show you how I believe that the market is overvalued. But with that said, if you look over here, you'll see that the Fed minutes point to further rate hikes that could go further than the market anticipates. And so essentially what we're seeing here is the potential for the market to decline further. The Fed is prepared to move ahead with multiple 50-point interest rate increases. And you can see from the second point here I've highlighted that they are open to causing a recession. They refer to it as restrictive territory. I call that a recession. So effectively what those minutes are doing is they're concluding that they are hopeful that they can bring down inflation, but they are concerned about the financial stability of the market as a whole and the economy. So that's really scary talk there. And I don't know if it's priced into the market as much as it should be. And going into that article a little bit more, the Fed is talking about going as high as 2.5 to 2.75 by the end of the year. I don't think that they go that high. I think the market will collapse if they do. Now, the other thing is, on a balance sheet issue, the plan is that the Federal Reserve is going to allow a capped level of proceeds to roll off each month. So in other words, they're reducing liquidity in the market. And they're even considering an outright sale of mortgage-backed securities if they need to do it. Do not underestimate how big of an issue it is when the Fed takes liquidity out of the market. I think that's another indication that this market could go lower. And in the last paragraph here, they've also noted that the war and the zero COVID policies could increase inflation further, which of course could potentially cause the Fed in the US to act even more so. So again, there's uncertainty moving in the direction that we don't necessarily want to see it go. So is there absolutely going to be a market decline? I'm not saying that. What I am saying is there is evidence to suggest that the market shouldn't be as bullish as it currently is being, or at least it was the last week, but I might be wrong. I'm not an economist. Let me know what you guys think in the comments below. Now, also guys, the one thing that I do want to point out to you is that in the next video, I'm going to talk about how high gas prices could effectively lead us into a recession. And so in order to not miss that video, please do me a favor right now and hit that red subscribe button and ring that notification bell to be notified when that video comes out. Now, as a third indicator of whether or not the market is overvalued or not, I like to look at the companies that I'm following. Now, of the companies that I'm following, I'm very selective with the names that I choose, but what you're seeing here is that there's only really 6 names in the tracker where the share prices are trading at 50% or less of their intrinsic value. There are 20 names of strong companies in the tracker that are trading near 50% of their intrinsic value, but there are a ton of names that are trading above 50% of their intrinsic values. Because I am selective of what names I put on, and I generally don't put on names that are obviously overvalued, I would suggest that from what I'm seeing, the market still has room to come down. Now, the interesting thing about this tracker is that it auto updates with the market movements to show in near real time opportunities that open up. And so having access to this tracker, as all the Patreons at the lowest level have, you're able to track opportunities such as Alphabet trading at near 50% of its intrinsic value. Now, the other thing is, notice that I highlighted Facebook's stock ticker symbol in red. And the reason why I highlighted that is because every single ticker contains a link that takes you into a full detailed model for that security. So you can see here, this is what happens when you click into Facebook. So you get this whole model, and you can download all of the models, every single one in this tracker, and change the inputs to suit your personal expectations. And I'm adding more models every week. And you can get access to all of that at the $5 a month Patreon level tier. And of course, if in the first month you decide that it's not for you, no problem. There's no risk to you because you can message me in Patreon and I'll fully refund that first month. So once again, no risk to you. Also, I'm currently in the process of putting out my Alibaba Q4 review. And if you've missed any of those videos, you can get to the latest video right here.